have I got a deal for you? That's right, I've done some research for all y'all out there in YouTube land. Hi, how's it going? Thanks for swinging on by Dapper Dividends. I'm Russ. I'll be your host for tonight. We are working to make work optional, and we're doing that through stock and a crypto passive income. So let's get into the number 5 company on the list that pays a high reliable dividend and is about 5%-ish. And number 5 is ticker PEBO, People's Bancorp. They're a banking service that has operations in Kentucky, Ohio, and West Virginia. And they were founded in 1902. We take a look at the chart. The dividend yield is 4.89%, 11.34 PE ratio. Itty bitty teeny tiny weeny market cap of $579 million. So I like regional banks because they don't face a lot of the scrutiny that the big banks do. They don't need to make the multi-billion-dollar deals. And a lot of times they're just off the radar of investors and the big institutions because they're so small. If they would invest in them, they would own the whole kit and caboodle. So this is fantastic. I love looking at the small micro caps. They could present very good investing opportunities, and this is one of them. They have a stellar balance sheet, and 94% of their liabilities are from low-risk funding. Dividend yield is 4.84%, paying out $1.44 annually. The 5-year growth rate, an astronomical 18.8% that has been growing for 10 years. And Seeking Alpha does show the payout ratio at 69.57%. But when I looked at the balance sheet, I see that the dividend of the trailing 12 months is only 33% of free cash flow. So that is a big thumbs up. And we do see a very nice 10-year growth chart with no cuts. Number 4, Philip Morris. You know him, you love him, you hate him, you use him. If you're health conscious, you probably liken their shift into the heat not burn and the better for you tobacco products. And they had an all-time high about June of 2017 when they hit $121 USD. Current yield 4.90% with a PE ratio of 17.70. Market cap of $152 billion. I do think they are one of the riskier companies on this list because they have a negative shareholder equity and about a 300% debt to equity ratio, which gets me a little bit nervous. The dividend is 4.86%, paying out a very nice $4.80 annually. Seeking Alpha shows the payout ratio is 78%, but when I do the math from the balance sheet, I get 87%, which is not worrisome because almost all of the SIN stocks have a much higher payout ratio because they don't want all that cash sitting around for regulators and such to look at, and also to be spending on things like Altria did with Juul. And they have been growing that dividend for 12 years. The 10-year dividend growth chart, again, very nice up and to the right for Philip Morris. Number 3 on the list is ticker MPW, Medical Properties Trust. They are one of the world's largest owners of hospitals. They have about 431 hospitals in their portfolio and roughly 43,000 licensed beds in 9 countries across 4 continents. Check that out. They had an all-time high of $24 in February of 2020, just before the pandemic hit. Dividend yield of 5.54%, PE ratio 21.64% with a market cap of $11.89 billion. Now they do have a bit of debt like most REITs do, but they have a very nice 38% profit margin. And again, that dividend yield is 5.48%, paying out about $1.12 annually. Payout ratio 64% with a 5-year growth rate of only 4.33%, and that dividend has been growing for 8 years. And once again, like clockwork, we've got a very nice up and to the right dividend growth chart, which is the name of the game, and that's the game I'm playing. And by the way, you should always know the game you're playing. When you take advice from anyone, make sure they're giving you advice for the game you're playing and not the game that they're playing, because it may be good advice for them, but not so much for you. What we're doing here again is dividend growth investing. That's the focus of the bulk of our portfolio. Now, I do have some growth positions that I'm into and some that I'm looking at that we will be sharing, but that's a small portion of the portfolio. The bulk of the heavy lifting is done by companies that pay a consistently stable and growing dividend. Number 2 on the list is ticker WPC. WPC carry has a market cap, as we can see, of $13 billion, P/E ratio of 29, meaning you are paying $29.99 for every $1 of earnings with a dividend yield of 5.58%. And they have a commercial real estate portfolio of about 1,215 net lease properties. Now, their earnings grew about 45% last year, and they're expected from analysts to grow about 15%. And their profit margin is also a very nice 35%. Check it out. They hit an all-time high of 93.45 in October of 2019. And we all know what happened after that, so they're marching their way back upward. Seeking Alpha has them with a dividend yield currently of 5.44%, paying out $4.20 annually, with a 5-year growth rate of only 1.57%. And I do contend that they are wrong with their dividend growth of a year. As you see here, they show a cut in 2019, but not the case. I looked into it. They have been growing their dividend and increasing it for over 20 years. So unfortunately, Seeking Alpha is wrong. And this is something, never take one site always as gospel. Always double check everything. Always go to the balance sheet. Check the company's SEC filings if you really want to get into it. Or if you don't want to get into it, just check 2 or 3 different website sources, because Seeking Alpha is wrong here. And the number 1 company that I have of an over 5% dividend yield with a high and reliable dividend payout is ticker BDN, Brandywine Realty Trust, which is one of the largest publicly traded full-service integrated REITs, and they do have a focus in the Washington, D.C., Philadelphia, and Austin markets. And what it means that they're integrated full service is that they own, develop, lease, and manage their properties, of which they have about 175 of that have about 27.4 million or so square feet. Last 5 years, we can see they chopped sideways until COVID hit. And they do have a solid balance sheet. We can see they have a market cap, again, of $2.34 billion, PE of 7.71. Now, I just did a video, you can check here, about when you see a company with a high yield and a low share price, that's usually a red flag that needs further investigation. Well, this is one of those cases where I did a little bit more digging, and I think they look good because they do have a solid balance sheet, and they have a very healthy 62% profit margin, and I think they have a lot of room to grow because they're only at just over $2 billion of market cap, and I think they can make moves in this space. Again, dividend yield of 5.53% according to Seeking Alpha, paying out 76% annually, payout ratio 55%, only a 4.84% 5-year growth rate. They have plenty of room to grow the dividend, and they've been raising it every couple of years as of late, and it's been at 76 cents a share since December of 2018. So those are the top 5. Let me know what you think of them. Do you own any of them? Full disclosure, I do not own any of these, not a single one of them. And if I had my toes in the fire and I had to pick one, honestly, I would pick People's Bancorp, because it's such a small market cap company that they have so much room to grow. They are, yes, a regional bank, but again, the regional banks, they have a low payout ratio. They can keep increasing that dividend. I think it's really safe, and you're going to get a lot better of a deal, I think, than some of the giant JP Morgans or Wells Fargo. Follow me on Twitter at RustyRam78. Leave a comment in the comment section below, because you know where the comments go. And check out this video I did on some more undervalued monthly dividend stocks, and I will talk to you there.